Hey, how are you doing? And welcome to the Trading Mail Show. Today we have camped at the Retirement Benefits Authority, and we're here to talk to the CEO, Mr. Nzomo Mutuku. And he's going to be telling us what is the future holding, especially for the pensioners, and are there good things to look ahead for? Come with me. Mr. Nzomo Mutuku is the Chief Executive Officer of the Retirement Benefits Authority and an ex officio member of the Board of Directors. Prior to his appointment, Mr. Mutuku had been seconded to the National Treasury and Planning as a Senior Advisor, Financial Sector and Acting Director, Financial and Sectoral Affairs Department. Previously, he was the Chief Manager, Research and Development at RBA and has worked with RBA since 2000, where he joined from the Central Bank of Kenya. Mr. Mutuku has a wealth of experience in the operations and activities of the financial sector. He has undertaken training in pensions and financial markets in various countries, including the UK, Canada, and USA at Harvard University and Wharton Business School. He holds a Master's of Arts degree in Economics, as well as a first-class honors Bachelor of Arts degree in Economics, and is a Fellow of the Economics Society of Kenya. Thank you so much, sir, for joining us, and welcome to the Trading Bell.
Thank you for having me on the show.
Absolutely. Well, when people hear about Retirement Benefits Authority, some question, what is this authority about? And maybe I would just want to start on that note of, could you briefly walk us through the authority's mandate to Kenyans?
Thank you.
Yeah.
Retirement Benefit Authority, RBA, is a regulatory body created by an Act of Parliament, the Retirement Benefits Act, which actually passed in 1997 and commenced in 2000. So our mandate is pretty straightforward. We have 5 things that we are supposed to do. One, we regulate and supervise pension schemes in Kenya. And we have over 1,000 schemes that we regulate.
Wow.
2, we protect the interests of the members of those schemes. So members are just ordinary Kenyans who are saving for retirement in schemes. And we have a mandate to protect their interests.
Wow.
3, we are there to develop the industry, make sure more people save for retirement, try to grow the numbers, the assets of the pension industry. 4, very important, we also advise government on policy issues to do with retirement of the industry. So we do a lot of research and we send memorandums to government on policy changes that we think would be good for our industry. And the last one is, of course, like any other government agencies, we support government in their policies. So with Vision 2030 is a Big 4 agenda and so on, we support the government. So that's what RBA is all about.
Okay, quite a handful, and matters of retirement are very close to people's hearts. And let me jump straight to how the organization has been doing. You recently celebrated your 20th anniversary. My question to you would be, what are some of the significant milestones achieved so far in RBA?
I think it's been a great 20 years for RBA and for the industry.
Yes.
We have seen the assets grow from less than 100 billion shillings to the current 1.48 trillion that we have as of June 2021. So that's huge growth. We have seen the people covered in pension arrangements grow from around 12% of the labor force to 22% currently covered. Over the 20 years also, we have developed a very robust pension industry in Kenya with a lot of variety of products. For example, we have umbrella schemes, we have individual personal plans which are open to anybody.
Yes.
We have what we call provident funds, pension schemes, defined benefit, defined contributions. And these schemes are also served by a strong cadre of professionals. So we have custodians who are banks who hold the assets of schemes, who we register. We have fund managers who are professional investors who do the investment, who we also register. We have administrators who do the day-to-day running of the scheme.
Okay.
Actuaries, I think when RBA came, we only had maybe 1 or 2 actuaries in Kenya. Now we have over 50 qualified actuaries in the country, accountants, lawyers, and so on. So we have a very robust and well-developed pension industry.
Okay.
And in fact, last year when Alliance did a survey of pension industries in Africa, they ranked us number 2 behind South Africa in terms of the development of our pension industry.
That's number 2 in Africa.
Number 2 in Africa, correct.
Wow,
Yes.
wow. Excellent. And I know I want to a little bit dig deeper on that, because you've talked about the contribution and the pension asset growing to, totaling, you said 1.48 trillion. What would you say is the key driver to this growth?
The key drivers to the growth, of course, are the efforts we have done in terms of getting more people on board. So, we have increased the coverage from 12% to 20%. So more people are saving.
Yes.
That will grow the assets. Number 2, making sure that those assets are invested in a very stable and, optimal manner. And once that happens, then the assets themselves will also grow.
Yeah.
And of course, the whole framework that you have put in place with the checks and balances, with the custodian, the fund manager, and so on, board of trustees, it ensures that the assets are safe, that you don't have leakages from the system. So with that kind of robust structure, we are definitely going to see a lot of growth, and that's what we have seen over the last 20 years.
Absolutely. Let me jump into your investment, and the asset allocation skew in the pension industry has been more towards the fixed income. Of course, one would really understand this based on the fact that they are sort of a safe haven and have a better appeal. But there has been concerns that the trustees or the overseers of these funds might not be maybe at a level or in the capacity to assess other asset classes. I don't know what your view on that is on this, and do you see the high exposure to fixed income as a risk?
I don't see it as a risk. If you look at our asset portfolio, we have around 44% of total assets in government fixed income securities. And then we have around 17% in equities in the NSC. Another maybe 16% in what we call guaranteed funds, insurance companies. And also around 16% in real estate investments. So when you look at that portfolio, it's actually pretty well diversified. In fact, if you compare with most African countries, you find government securities is maybe 70-80% of the total portfolio. But here we are talking about only 44%. So I think with this diversification, pension schemes are pretty cushioned against shocks from coming from different sides. We also have a little bit offshore. We have emerging amounts in what we call alternative investments. So like private equity, we have come up from 500 million, now we are around 2.5 billion shillings, which is in private equity. REITs, we have amounts there. So I mean, we have a pretty well diversified portfolio. So I think the risks are well managed. And of course, like I mentioned, yes, the trustees are the ultimate owners on behalf of the members, but they use professional fund managers to do the investment. So the investment is being done by the fund managers who are registered by both ourselves and by the Capital Markets Authority.
Of course, I would want to also dwell on that because, and I love the fact that you've mentioned that even, some of the investments at the NSE and all that, and it's commendable in terms of percentages that you're looking at. But as we go on, and we privately had a conversation about this, there are new ways that are coming up, and new investments portfolios, new asset classes as well that are coming up, and even new instruments of trade. For example, I could talk about the derivatives market, but the NSE. Are you seeing yourselves as well diversifying to these levels? In fact, the question would be, what's your risk appetite in terms of really looking at these new ways of, investing this cash?
Interestingly, this is one case where the regulator is kind of like ahead of the market.
Wow.
So when you look at our investment guidelines, they do allow schemes to invest in a lot of these new things, though they may not necessarily be in the market yet, or schemes may not necessarily have put money there. So for example, we allow derivatives, which is a new class.
Wow.
We allow exchange-traded funds, which we only have one in the market, and we have some investment there. Recently, we brought a new category for infrastructure. So schemes can invest in infrastructure and support the government in affordable housing projects or infrastructure projects through PPPs like the ones that are coming up. So we have these already allowed in our guidelines, but they have not really been taken up yet because the products are not yet there. But we expect the products to come, and then the schemes will be able to invest.
Some people on the ground sometimes, are not satisfied, if I may use that word, with some of the returns they get, from some of the schemes they take up. I don't know what would be your comment on them in terms of a regulatory perspective. Is it their patience levels that need to grow a little bit more, or, from where you see it, what are some of your advice to such?
I think pensions is a long-term business.
Yeah.
People are, saving for many, many years, and then they will get the money much later.
Mm-hmm.
So one should not be worried about short-term volatility.
Okay.
When you have a diversified portfolio like this,
Mm-hmm.
things will move up and down. If you take the equity market, some
Yeah.
years are good years,
Mm-hmm.
some years are bad years,
Mm-hmm.
or some quarters are good quarters, some quarters are bad quarters.
Yeah.
But one should not be bothered about that short-term volatility. I think if you look at what pension schemes have delivered to their members over 10 years,
Yeah.
it's been a very good return,
Okay.
and well above inflation.
Mm-hmm.
So just urge members not to worry about short-term issues. Let's look at the long-term, because pensions is long-term.
All right, that's some hope, definitely, and some lessons there to take home. As an industry as well, definitely you've not been spared from the COVID-19 pandemic, and I would want to hear from you, and how was it for you, and some of the key lessons that you took out from it.
Yes, of course, COVID impacted pensions just like the rest of the economy and other sectors. For us, we had like triple shock, which is a bit rare, because even when we do what we call stress testing and try to see how resilient our system is,
Yes.
we anticipate one shock or maybe two shocks, but now we had three shocks.
Mm-hmm.
The three shocks were, one, we had people who lost their jobs and came
Yes.
and took their money out of the system, because
Okay.
in the Kenyan pension system,
Yeah.
if you lose your job, you can get an amount of the money out. So actually, the majority of what you have saved, you can take it out. So those who lost their jobs took their money out, which is a good thing, because if you have lost your job suddenly,
Okay.
it's good that you have this cushion that your pension can give you. So it helped them in that circumstance. So that was one shock, money leaving the system.
Yeah.
The second shock was on the contribution side. Some employers either stopped business, sent their workers on unpaid leave, so they didn't retrench them, but they were like on unpaid leave, or less pay and so on.
Yeah.
So this meant they were not contributing, or they were contributing less than what they would normally contribute.
Definitely.
Like those who had closed, like hotels, they were not contributing to the pension scheme.
Okay.
So that was another shock. And then, of course, we had a shock on the investment side, because as we have just said, there's a lot of volatility, and we saw the markets impacted when COVID came.
Absolutely.
So yes, it was a difficult time, but I think we have now seen a lot of resilience. If you look at the period between December 2019
Yeah.
and now, our asset base has come from 1.2 something trillion to the 1.48. So we
Yeah.
have still been able to grow. So it shows our industry is resilient despite those shocks. I think now we are seeing slow return to normalcy. Some of the people who had suspended contributions have come back, and now they're making the full contributions.
We just closed on how the COVID impact was, and definitely an advice to people that, the market can be volatile, and, there are unexpected things that come around, but we need to be more patient, as you have said. The other key question is that research has it that by 2030, the number of Kenyans aged 60 years and above will rise from 1.6 million currently to about 3.4 million. So in ensuring that this demographic doesn't become a time bomb by itself, I don't know what measures you have in place to ensure that, all these persons as well will have the benefits and the advice needed so that they have, safe retirement.
Absolutely. Kenya has been lucky that our population has been very young, and we have not had what we call a high dependency ratio, where we have many people who are retired, who are being sort of financed by the younger group. In our case, we have had a young population. But that is changing. As we go forward, we are going to have more and more older people. And the dependency ratio is going to increase. So really, the key is to take action now. We don't wait until that time and then start saying, now what do we, how do we handle all these numbers and so on. And the action that we need to take is for those who are working today, who are still young, to be saving for their retirement. So that when they reach retirement, they will have this pot of money that will keep them in retirement.
Yeah.
Traditionally, people would say that when they retire, they will get their children to come and take care of them, and those kind of things.
Yeah.
Those structures.
Yeah.
But those have broken down.
They call it, I think, outside there, the black tax.
Yes.
Yes.
But those have broken down. Chances are when you retire, your children may not even be in the country. They may have migrated to other countries, or they could be doing other things and so on. Or you may even have to take care of them. We have seen those cases where people are taking care of their children as well when they retire. So really the key is for you to start saving at a young age. When you start saving when you're still young, you don't have to save much. You just save a small amount. It goes into the pension scheme. But because of the power of compounding, it is invested and it earns income, and the income is also invested and it earns income, and that income earns income. When you reach retirement, what you get, what you have saved is not much, but what you have gotten in terms of investment income is huge. And that is what gives you a comfortable life. So with that demographic pressure coming, I think the challenge is to Kenyans that you really need to start saving for your retirement. Yes,
Certainly.
Government can give the government may give basic social security, which through, for example, the Inua Jamii program, which is there, which gives some money to people over 70. But this is really just money to avoid people being in absolute poverty. It's not money that you can use as income replacement when you're retired.
Absolutely. And as I said again, the key time bomb here will be that there will be less saved because of course, those demographic changes, and much more used at the family level and even nationally. And so you have proposed that the Kenya Institute of Universal Pension Coverage for Citizens should deal with this issue. How can this be actualized?
Universal coverage is important in pensions.
Yes.
And the challenge we have in Kenya is that we have a voluntary system of saving for retirement. So people voluntarily save themselves, because we have products that can allow you to save, whether you're in the informal sector or the formal sector. You can save through the products that we have. Or they save through employer-created schemes. So the employer starts a scheme, and then the people are saving, and the employer is also contributing. But again, even for the employer, it is voluntary. So not all employers have schemes. In fact, many employers don't have pension schemes for their workers at all. So I think the solution is we need to go to a more compulsory system where everybody is required to save for retirement. Perhaps as an intermediate step, we could go for what they have done in some countries, which is what they call an opt-in system. Or opt-out system. So they put everybody into a scheme, and if somebody feels so strongly that they don't want to save, then they can opt out.
They can opt out.
But at least, most people end up just staying in because they realize the value of saving.
From where I sit and from what you're saying as well, it's very important that people really think through their retirement. And so, what is the hindrance from where you sit? Why are Kenyans not running in to safeguard their future?
There are a number of issues. One, generally, as not just Kenyans, as humans, we suffer from what we call myopia. So we tend to think, short term. We don't really want to think about very far ahead. When we are young, we imagine we'll be young forever. So, when you talk to some people when they're young, they say, I still have plenty of time. I'm going to start saving when I get older. But like I said, the earlier you start, the less you're going to, you're going to have to save. So there's that short-term thinking. I think also traditionally the pension products we have were not, in harmony with the labor market we have, because our labor market is mainly in the informal sector, but the traditional pension scheme was in the formal sector. So now is when we have come up with these new products which target the informal sector. They use the mobile phones. They don't need to have bank accounts. They don't need to have payrolls and those kind of structure. So it's very easy now for anybody to save for retirement. So I think the challenge will be just getting the word out, doing the education, so people can know that these products are there. And then they save. And of course, these products are tax advantaged. When you save for retirement through a pension scheme, it is a tax advantaged way of saving as opposed to any other form of saving that you may do.
So we come to the tail end of the interview, and I would like you to enlighten the viewers. Somebody is seated there saying, okay, I hear you, they run a business, maybe they're not in a formal employment, and they're thinking, maybe I need to start thinking about this, what would you tell them? Because somebody there is thinking, I have not even started anything, and they're in their 40s, hitting 50s there. What would you tell them?
It's never too late, of course.
Yes.
Even if you're in the 40s or 50s, you can still start saving for retirement. And we have the products. So if you have a lot of channels that we have a toll-free line. You can call us. We can advise you. We have our website, which has a lot of information, and also links to the pension schemes that you can join. So what you do is, if you're in a business and you don't have a scheme for the employer, like in big companies, you join what we call an individual personal pension plan. So individual personal pension is open to anybody to join. If you're a mama mboga, you can join it. If you're a border rider, you can join it. If you're a taxi driver, Uber or whatever, you can join an individual pension plan.
Absolutely.
And then you'll be putting something in there. And it doesn't have to be on monthly basis. It can be when and if income comes. So it's very flexible.
Absolutely.
And then it will be invested, it will continue to grow, and then when you're older you can come back and get that money out, and it will help you in your retirement.
Okay. I wouldn't want to end this interview without asking you to help us, because some people may be pointed out to, let me call them Ponzi or fake, people who want to just take up their schemes, and we have had some people cry for about such kind of things. Is there a way they can verify through you that these are valid places where you can invest your money? Yes. Even on our website, we have the list of all the regulated individual pension plans. There are around 35 that we have registered. Okay.
We have the list of the fund managers, the custodians. We have registered. So I think as financial sector regulators, we cannot overemphasize the message. Please use financial products which are regulated.
Yes.
Once you go putting your money in unregulated products, you don't have any protections. Absolutely. But when you use regulated products, you are protected. You have the regulators in place to make sure that your money is safe. Absolutely.
So the final question will be about some of the innovations that you have in the pipeline. I know there are a few of them. Could you enlighten us on that?
Yes, absolutely. We have moved away from sort of the traditional pension product to bring about some really exciting innovations in our pension industry. So one of them is what we call the post-retirement medical fund. What we realized from our research and our interaction with people who have retired is that medical expense is a big challenge for elderly persons in this country. So what we have done is, within the pension scheme, as you save for your pension, you can also put something else on the side, which is specifically to cater for your medical in retirement. Yes. So you have this fund called the post-retirement medical fund. You accumulate money there, and then when you reach retirement age, that money is specifically used to buy medical for you for the rest of your life, because it's a challenge to get medical cover when you're old. So it's a great product. It's there. It's also enjoying the tax advantages that we have. It's a regulated product, so at least you will get your money, those years down the line, and your medical in retirement would be catered for. Okay. The second exciting innovation, which is also quite recent, is with regard to housing. We also realized that sometimes people were retiring and they didn't have a house of their own that they owned. It can be a bit awkward when you are you have nowhere to go and so on and you're retired. We have a new product which allows you, even before retirement age, to use part of what you have saved in the pension scheme to buy a house. Wow. Actually, you can use up to 40% of what you have saved. With the affordable housing program that we are seeing government and private sector doing, we now have supply of houses at good price. So members of pension schemes can get some of their money, even at a young age, even at 40 or 50, get that money and buy a house. So by the time they retire, at least housing is not going to be a concern. So I think if we will have catered for housing and medical of our retirees, then our retirees are going to have very good life in retirement. Wow. Lovely. By the way, quick question. At what age should one start saving for their retirement? That's a quick shot. Start saving as soon as you start working. As soon as you start working? As soon as you start working. Don't delay. Because the earlier you start, the less you'll be saving a very small amount. If the later you start, then the more you have to save in order to accumulate enough. Absolutely. But when you start young, you save very little, but it will be more than enough when you reach retirement.
Wow. Start where you are right away. That's Mr. Nzomo Mutuku, the CEO of RBA, right here on the Trading Bell Show, telling us about what RBA is doing and some of the initiatives they have and the innovations they have in the pipeline. Lovely way to really end the conversation. Right now, we leave you with the markets.